All right, today we're tackling Red Cat Holdings and their wild third quarter earnings. You've got management on one side talking about absolutely record breaking growth, but then you have the market, which just slammed the stock. So, what's the deal? Let's get into it. Almost 10% down. That's what the market thought of the news, right out of the gate. So, how does a company with supposedly great news get hit that hard? That's the big question we're going to answer. We need to dig into the numbers and the story behind this pretty brutal sell off. So, first up, the post earnings sell off. I mean, the market's reaction was fast and it was harsh. The stock got hammered on earnings day, and that selling just kept going into the next day on some really heavy volume. We're talking 1.5 times the usual. This was way more than a little dip. Investors were sending a very clear message. Okay, section 2, a quarter of contradictions. And that really is the perfect way to describe it. Because when you look at the results, you see this massive tug of war. On one hand, you've got some amazing news, but on the other, you have some really not so great news. Let's start with the good news, the really good news. Check this out, a 646% increase in revenue. I mean, that is just a staggering number, right? They hit $9.6 million, and this was mostly because they started delivering drones for a big U.S. Army program. The CEO even called it record-breaking, and you can bet this is the number they were hoping everyone would focus on. But, and this is a huge but, here's the other side of that story, a loss of 16 cents per share. And look, a loss was expected, but not this big. Wall Street was looking for a loss of about 9 cents, so this was a 78% miss, a huge miss, and that pretty much killed the party right there. And this table just lays it all out perfectly. You can see it right here. Revenue? A beat. They brought in more money than analysts expected. Awesome. But then you look at the earnings per share, the EPS, a big miss. That top line beat got completely canceled out by the ugly bottom line. And for a company like Red Cat, which is in growth mode and burning through cash, investors need to see a path to making money. This result, it was a major red flag. So let's talk about gross margin for a sec. Basically, it's what's left over from your sales after you pay for what it costs to make the stuff you sold. Now for Red Cat, they actually went from a negative 30% margin last year to a positive 7% this quarter. That's a massive improvement, no doubt. But a 7% margin is still incredibly thin. It tells you that it's still costing them a ton of money to build these drones, and real sustainable profitability, yeah, that's still a long way off. All right, section 3, the severe guidance reset. So if that earnings miss was the first punch, what came next was the knockout blow. Management didn't just lower their expectations for the year, they absolutely demolished them. Just look at this. The old guidance was for somewhere between $80 and $120 million in revenue for the year. The new guidance, $34 to $37 million. That is a massive, massive cut. We're talking about a reduction of nearly 65%. If you're an investor who bought the stock based on that original, bigger number, well, this is devastating. It completely changes the story. So how did they explain this? The CEO, Jeff Thompson, said unanticipated delays basically pushed some revenue back by about 6 or 7 weeks. He really tried to hammer home the point that the long-term plan hasn't changed, but, the market doesn't always have that kind of patience. It was focused on the huge cut happening right now. Okay, so let's break down the reasons. There were 2 big ones. First, as we just heard, some government contract delays. Okay, that happens. But the second one, this is a biggie. They had a drone called the Edge 130, and they were expecting about $25 million in revenue from it. Well, that's now completely off the table for this year. They've decided to pull it back and redesign it to be tougher for the military. That's a huge chunk of expected revenue that just vanished. And this really brings us to the heart of the matter with Red Cat, which is this battle between vision and execution. You've got this grand, ambitious vision for the future from management, and then you have the cold, hard numbers of today. They're burning through cash and losing money. The CEO's big idea, his core strategy, is that factories are the moat for defense. What he means is that their real advantage won't be just one cool drone, but the ability to build thousands of them. And uncrewed boats, too. They're investing heavily in massive manufacturing capacity. Well, building a moat like that is incredibly expensive. Look at this number, nearly $53 million. That's how much cash they burned through in just the last 9 months to fund this vision. And when you see a number like that, and at the same time they're slashing their revenue forecast, you can see why investors are getting pretty nervous.
So, to get investors on board with all that spending, management is pointing to the huge potential down the road. Take their new maritime division, Blue Ops. The CEO threw this out there. If we only ship 200 boats, that is $150 million in revenue. That's the dream they're selling, the idea that new projects could generate revenue that makes their current business look tiny. And then, bam, back to reality. While they're talking about a potential $150 million in future revenue, right now, in this last quarter, they lost $16 million. This is what we mean by the execution gap. There's this massive space between the exciting story about the future and what's actually happening with the finances today.
Now, you might be thinking, well, maybe the whole defense sector is down. Nope, not at all. Look at this chart. Over the last month, RCAT is down over 50%. The main defense ETF, basically flat. So all of this pain, it's a red cat story, not a market story. It's all about their results and their guidance. Okay, last section. So after all that, what comes next? Here's our take on what to expect for the next earnings call. So for Q4, we think they'll probably hit their new, much lower revenue target of around 20 to 23 million. The Army deliveries should keep coming. The real thing to watch, though, is going to be that gross margin number. Can they make it any better? That's critical. For the stock itself, expect a bumpy ride. It's going to be caught between people who buy into the long-term vision and people who are worried about the cash burn and the execution. It'll probably be stuck in a range until there's some big new catalyst. And that brings us to our rating. Market perform. And honestly, is because the company is stuck between two extremes. The potential here is huge. I mean, autonomous defense tech is a massive market, but the risks right now, the cash burn, the guidance cuts, the questions about execution, they're just too big to ignore. It's a balancing act, and for now, we see it performing in line with the market. This is not financial advice.